Good afternoon, everybody. Hope you're having a wonderful summer. Today is the launch. Today's a class for the public. We're glad you're here. It's the launch of our new online class that'll be starting up. Today, what I'm going to be going over is for educational purposes only. So let me just dig right in, get a few of the preliminaries out of the way, and we'll look at butterflies for a little bit. So I have not taught an online butterfly class for over a year and a half, and we've done some tweaks to a lot of the different butterflies. I thought it was good timing for that. Today we're just going to talk about butterflies a little bit, a little preview into the class. Mainly want to tell you what we're doing. We'll be starting the new online butterfly class. It'll be a 4-week class starting July 27th, which is 2 weeks from yesterday, July 27th. This is a basic of the class. I may tweak a few of the butterflies, but you can see July 27th, which is a Wednesday. We'll be going Wednesdays and Fridays. I'll be teaching butterfly basics in the Greeks, kind of setting the foundation for this very popular and effective strategy. July 29th, that Friday, that'll be the first week of the class, I'll be teaching on weekly butterflies and some of the more successful methodologies that we teach. All the class times, except for the one Jay does, will be 1 p.m. Central. But what's nice about when we do an online class, whether you can show up or not, they'll all be recorded and archived. And even if you miss a class and you go back and you had 7 questions, on the class page, you'll enter the questions and then they'll come to me. So let me just quickly go over this class schedule and outline, then we'll go over a few things for today. I'll get the questions in just a second. July 29th, weekly butterflies. August 3rd, Mark Fenton, who works with me, we'll be talking about a flat-put fly. Mark, besides being a very busy mentor at Sheridan Mentoring, he manages a 7-figure account for some of the family members and their stuff, and basically does butterflies, different types of butterflies. So I think he's going to be teaching a couple sessions on the butterflies, and he can give you firsthand what he's doing, what's seemed to be working. But he's doing this on really large size, and I think it'll be very effective with you. Jay Bailey, August 5th, another long-term mentor with myself, has got a very effective butterfly that many use, and he's got some tweaks to it. The mango butterfly, which is an at-the-money kind of unbalanced butterfly, very effective. A butterfly, and a lot of people have been doing it in live trading in the community for years, and I think that'll be a big help. August 10th, you could see there, and August 12th, that'll be the 3rd week, balanced butterflies, broken wing butterflies, and then the last week, August 17th, Mark will be talking about directional butterflies, and then I'm going to skip to the next week, give you a little time to digest the material, and then I'll have a review and kind of make a battle plan for you. But basically, what we're going to be going over, Jay, myself, and Mark, some of the most effective butterflies that we've been using over the last 5 or 6 years with a lot of the students in live trading, and that have been working really well, and with the latest tweaks and modifications to it. So I think that'll be very practical and helpful. Most of these classes will be, I know the classes I'll be doing a live trade every class, so you can see the trade. We'll follow it through just to give you that practical example. That's what you want. So class times are 1 p.m. Central. The cost is $397, and that'll be a 4-week class. So the classes will go about an hour to an hour and a half. So you're talking about 8 to 12 hours of material, probably be around 10 hours of material. The neat thing is all classes are archived and recorded, like all of our classes, and probably the best feature is that during the 4 weeks, 5 weeks of the class, even months and months after, you can go to the class page. You'll have your login to go to the butterfly class page, and you can ask questions. So a lot of people won't be, I don't know about a lot, but some people won't be able to make that specific time all the time. So you sign up, But if you watch it late at night when you come home from work or early in the morning and you have 6 questions, just throw them in, right? And I'd be happy to answer them. So that's nice. Q&A during and after the class. And as I said, live trades, presenters will enter live trades for various butterflies. As far as how many trades will you initiate in the course? Good question, Ethan. Again, every butterfly that we go over, especially the ones I go over, I will always do live trades to show you how to do it, show you how to execute the trades, how I would execute them, what prices I would look for, how to manage them once they're on, and from beginning to end. Because I think it's good that you see it has to be practical, right? So we're going to give you guidelines, rules, and then walk through the butterfly. And as I said, all of these have been traded extensively in our community and with students live for a long time. So these aren't just like trades that were thought of over a hot dog at Portillo's. But every strategy that I go over will be live trade. All right, any other questions as far as adjusting the trades according to the Greeks or price? Oh, we do both. Again, that's the nice thing about being able to spend 4 weeks on an important strategy like butterflies. We'll talk about extensively into adjustments and how we would manage these trades, and obviously by the Greeks, you're not leaving the Greeks out of adjustments. That's part of it. Will the class focus on weekly flies? It won't just be, so we're not going to go 4 weeks on weekly butterflies. All the butterflies we're talking about, you can do any duration. So I will be talking about weeklies quite a bit, but again, any of these butterflies can be used at any duration, right? Whether it's 7 days out, 40 days out. We generally do 2 types of durations. We might do some duration on butterflies 30 to 50 days or 30 to 60 days out, and then some butterflies shorter term 7 to 14 days from expiration, so both. But any butterfly, you can do any duration, right? The key is you want to, I like to diversify a little bit. You know, if I have $10,000 worth of butterflies, I might put $7,000 or 70% into butterflies with a duration of 30 to 60 days from expiration, and then maybe a lesser amount, $3,000, into butterflies, weekly butterflies with a duration of maybe 7 to 12 days. Steve said, Dan, would it be fair to categorize the class as Butterfly 101? Absolutely not. I think, you know, we've been trading these types of butterflies for a long time. I mean, I think the material is going to be more medium advanced, but I think the way we teach it, and I know Mark and Jay, myself, what we've tried to do is take some of these none of them are complicated to me, but some of these butterflies, and we just try to make them as simple as possible and try to make them as effective and simple. Complicated doesn't mean better. You know, when I was in the pit for 20-some years, we did some really complicated stuff, but for different reasons. And so what I have found over the last 15 years of teaching retail traders, you know, it's important to have risk management, but it's important to have a simple plan because, you know, most people aren't in front of their computer 8 hours a day. So we have simple plans, but we cover adjustments and everything. And I think we have some of the most effective butterfly techniques out there. And so I think it should be a help to you. Will you be doing debit butterflies as well as credit? I'm trading with a small account, so margin is limited. Yeah, there's no difference between a debit and a credit butterfly. We'll cover both of them. I'll go over an example of a credit butterfly today and a debit. But bottom line is, this class is whether you're a beginner, intermediate, or advanced, I think you can get a lot out of this. As far as you say, Dan, how can you hit beginners and advanced at the same time? Well, because it's archived, because you can ask questions, because we're putting on trades for every class, at least I am, and because there's some repetition, I think a beginner person, even if they're willing to work at it, this is a great opportunity for them because it's practical, right? This isn't classroom stuff. But for the advanced guy, intermediate and advanced, yeah, you're getting the latest I think that's some of the most effective butterfly techniques out there, and I think it'll be a big benefit to you. And again, if you're, I don't know what advanced means or medium, but if you're advanced, you can, you can ask questions, advanced, whatever. But again, I traded, in the pit for 24 years before, or 23 years, whatever it was, before I did retail trading, and I constantly try to make things simple. So, I don't want you to get the idea that a veteran trader, you should be more complicated in your trading. Oh no, no. So, all right. Well, let's move on, everybody. Glad you're here, and we're just going to delve into this topic of butterflies today. So today's class outline, I just want to go over an example of I'm going to use SPX today. I'm going to go over an SPX weekly iron butterfly and discussion of trade execution, because that can be a confusing topic. And then I'm going to go SPX, a longer duration butterfly, and discussion of trade execution. And I think the reason I chose to do two different durations is because, their Greeks are different. And I think you'll get a good broad scale of the butterfly this way. Now, there's a lot of different type butterflies we trade, and but I think I'm just trying to set a foundation a little bit today on the beautiful world of butterflies. So here's a weekly iron butterfly example that I looked at. So these slides I took, I just built them a couple hours ago, and so we're pretty close, right? SPX is what, 2163. I took this at 2165. So here's a weekly iron butterfly example. Now, when you say weekly, you got to be careful, because you can trade a weekly 30-day iron butterfly, can't you? They have different weekly options. So weekly, I'm talking about something maybe 7, 8, 9 days from expiration. You understand? So here's an example, sell 1 July 22 expiration. Say, Dan, when's the July 22 expiration? The July 22 expiration is a week from tomorrow. So how many days is that from expiration? 8. So we're talking about an 8 days from expiration, a weekly iron butterfly, right? 8-day butterfly. If I put it on every Thursday, 8-day butterfly, right? So in this example, when we were at 2165 a couple hours ago, selling 1, this is a iron butterfly. This will be for those of you who think credits are better than debits with iron butterflies, even though you're wrong. But if you think it is, maybe you're a banker or something, and somehow you think getting credits is better than debits, hey, more power to you, right? As long as you don't tell anybody, it doesn't matter, right? All right, so the foundation of an iron butterfly is basically selling an at-the-money straddle, right? Dan, what's an at-the-money straddle? Sell an at-the-money call and put, right? Has anybody ever just sold naked an at-the-money call or put? Yes or no? Has anybody ever sold the foundation of an iron butterfly selling an at-the-money call and put? So first of all, why would somebody sell an at-the-money call or put? Why? Give me a reason why you would. What would be a reason in a court of law in front of the Supreme Court Justice? Why would you sell an at-the-money call and put? So in this case, 8 days to expiration. Why would you sell it? Well, which options have the most time premium and the most decay? Your at-the-money options. So if you look at this example with SPX at 2165 and 8 days to go, we're selling an at-the-money 2165 call for 12 bucks, and we're selling a 2165 put basically at the money for about $13. So the at the money straddle, right, you're bringing in $25, right? Now I'm making one change here just because I forgot. I think I made it on one copy, but I must not have sent it over to my nephew. Don't get caught up in the numbers. It's just a little, I was trying to make this as beautiful as possible for you, but if you add the numbers up, we'll get to it in a second. But so the foundation for an iron butterfly is I'm selling an at-the-money call and put. So everybody got that? Now, why wouldn't you sell at your brokerage firm? What would be a reason you wouldn't? So there's nothing, it's a very nice reason to sell an at-the-money call and put, a short straddle, 8 days from expiration. In this case, if I sell it for 12 the calls, 13 the puts, I'm bringing in 25 bucks, right? $25, right? In 8 days, if we close at 21.65, right, there's no value. It's at zero, right, this straddle. And I'm selling it for $25. If I can get some of that decay, right, as Marlon Brando said in over the, what was it, the Waterfront movie, whatever it is, hey, I could have been a contender, right? That's $25 of juice, $25 of time premium. I'm salivating, right? Give me a break. The delta is 50 for the calls and puts. Now, if I go to a brokerage firm like Thinkorswim or Trade King or TradeStation or Options House, and I want to sell an at-the-money straddle, what's going to be an eye-opener for me? If I go in and try to sell a naked at-the-money straddle, right, what's going to happen? They're going to ask for collateral, your wife, your mother-in-law, 2 of your small children, all your golf clubs, and your collection of crazy swimming suits that you got when you were in Hawaii. So what do people do? Would we all like to sell these decaying options if we could? Yeah, I would. I'd like to sell decaying options. I like to sell decaying options, but I don't like this naked option stuff. In other words, your brokerage firm will charge you an awful lot of money to sell a one-contract short straddle. But the biggest problem isn't just the capital you have to put up, agree? It's that, what are you in this game for? You're in this game for to get the best yield on your money that you can, right? And so that's why we do spreads. I have nothing against naked, well, I have plenty against naked options. Unless you're selling maybe a cash secured put to buy the stock, the biggest problem I have with naked options, right, is that it eats up a lot of stinking capital, right? I mean, yeah, Dino made a good point. You can get into the risk factor, but this is a yield game, right? If you make 10 grand a month on $10 million and another guy makes 10 grand a month on $150,000, who wins the teddy bear? The guy who makes the 10 grand on 150, agree? And I think that's important is what's the yield that you're making on these things? You know, someone may say, well, Dan, I got $1 million in the bank and I'm only trading 10 grand of options trades. It doesn't matter the nakeds. Well, to me, it does, right? You always want to have an efficient use of capital. So the foundation of a weekly iron butterfly or any iron butterfly is the, and again, when you're talking about this concept of an iron butterfly, you're just saying you're doing a call credit spread and a put credit spread. So we start out with this selling an at-the-money call and an at-the-money put. So if we sell those two for $12 and $13, $25, theoretically, if in 8 days SPX closed exactly at $21.65, we'd make the whole $25 and it'd be Beverly Hillbillies, wouldn't it? You know, we'd be off to the races. Now, it doesn't happen like that. So because we're rational human beings, because we have limited capital, we're going to buy some protection, aren't we? Right? You agree we're reasonable people. We're supposed to be reasonable. Yeah, as Dino says, you can cut your margin by 98%. That's pretty good, by turning the straddle into an iron butterfly. So the foundation of a iron butterfly, you sell the straddle, and then you're going to buy a strangle. So I'm going to buy, on the upside, I'm going to buy the 21.85 calls, 20 points up, and I'm going to buy the 21.45 puts, 20 points down. And you can see the delta of my call, 20 points away, is 24, and the delta of the put 20 points away is 28. Can anybody tell me why the put is more expensive and the delta is higher than the call, and they're both 20 points away from the current price? Can anybody tell me that? Why is the put more expensive and a higher delta? Yeah, the skew, fear is priced in, all of that. Yeah, it's the, but a lot of it is, you know, it's just people are going to pay more for a put 20, 30 points out of the money than a call 20 points out of the money. Why? We don't stink and crash up, right? We don't crash up usually. Now, total credit for this, and I like, you know, butterflies is probably, as far as my favorite weekly trade, butterflies, because a great risk reward. So the total credit here is $14.60, right? If you add up my prices, $25 for the short straddle, $10 for the long strangle, 10 from 25 would be a $15 credit. But then I went into the market, and a little more accurate, $14.60. So this should be $11.60. But you get the idea. I was just trying to make it. I didn't want the overly focus on the numbers. I want you to get the strategy. So sometimes it's easier to use whole numbers. But anyways, the credit is near $15. This was about $14.60. And this is a weekly trade, right? So the position Greeks, and this is for an 8-day butterfly, and I want you to focus on these Greeks because they're going to be quite a bit different when we look at a 38-day trade. So the position Greeks for the position is we start out deltas of short 3, right? So this is the position deltas, not the deltas of the individual options. The net position deltas. And why do you think, if you do a balanced butterfly in the Russell or SPX, why do you think you're always going to be starting out a little bit short delta? What do I mean balanced butterfly? Balanced means if we're at the money is 21.65, and I'm buying my wings, right, 20 points up and 20 points down, that's called balanced. Right? So if I do a balanced at-the-money butterfly, why am I always going to lean short deltas? Why am I always going to lean short deltas in SPX or RUT? This doesn't hold true for most equities, but why am I always going to lean short deltas? Puts are more expensive than the calls, like Dino said, right? And the skew, yeah, a 20, you know, your puts are going to be more expensive, and your call, your long call is going to be less expensive than your long put. So you're going to have in your long, as you look here, the call long delta, but just look at it, is 24, right? And your put delta is 28. So on the call, you know, this iron butterfly, you're doing a call credit spread and put credit spread. Well, the call credit spread, if you look at it here, basically if you take the call side, 24 from 50, you're 26 deltas short from the call credit spread. What are you picking up on the put credit spread? 28, 38, 48. If you subtract 80 from 28, 22. So you're always going to be a little bit short deltas on the iron butterfly. Why? Because the delta of your long call is going to be less than the delta of your long put. And so because your deltas of your at-the-money options are both going to be 50, you're going to be a little short delta. So, and we'll get a lot more into the class because of that propensity to start short deltas at the beginning for SPX and RUT, not all stocks. We trade these sometimes in different ways. Anyways, so if you look at the Greeks, all right, so it's important to focus on the Greeks of an, you know, to me, they're two different trades. If I'm trading an 8-day butterfly versus if I'm trading an 8-day butterfly versus a 38-day butterfly, it's two stinking trades, two totally different trades, right? My deltas are short 3. My gamma is short 0.89. My theta, or time decay, and this is the day I put it on at 8 weeks, 8 days out, is 42. So that means that's a theoretical number, I make $42. The vega, the short vega, is short 59. So the reason a lot of times I will say, hey, if I'm trading a 8-day trade, butterfly, calendar, iron condor, 8-day meaning there's 8 days till expiration, volatility is not that big of a component. It's there. I look at it, but it's not that big of a deal. Hey, Dan, why is volatility not that big of a deal? when you're looking at 8-day trades? Here's your answer. Because, as we'll see in a second when we look at 38-day trades, where Vega's a lot bigger than theta, right? Is the theta number almost as big as the Vega number? Can the theta number hold up its own in a fight against the Vega number? Yes or no? Is the theta almost as big as the Vega number? Yeah. And that's just the first day. By the time you get to the second or third day, it's bigger. Whereas when you start getting into 38-day trades, whether it be a butterfly, iron condor, or calendar, the biggest Greek on the block, right, is Vega, right? So volatility is it becomes a bigger component. So when I'm looking at weekly trades, whether it be an iron condor, butterfly, calendar, the most important thing is price risk. And theta is the big deal. So I'm not looking at volatility as much. It might be on my 5 most important things to look at, it might be number 5, right? Now my max loss and margin is $540, okay? If we're taking the butterfly at 1160, all right? How do you figure your margin or risk or how much you have to put up at your brokerage firm? All you do is take the difference in the strikes. This is a 20-point wide butterfly. So we have $2,000 of risk. I'm looking at my long call from my short call, $2,000, and we're bringing in a credit of, you're bringing in a total credit of $14.60. So you take the width of the spreads minus your credit, gives you a margin of $540. That's your total risk, and that's also what you put up at your brokerage firm, right? So margin is, so it's a great risk-reward trade, right? Not that we're going to make the total credit. So we're bringing in almost $15 of credit to lose about $500, right? Now, what's significant here, folks, is this. When you're dealing with these types of positions, here's something I want to point out. If you look at theta, and you look at the capital you put up, this is the first day you put the trade on. What is your theta as a percentage of your margin or risk? So the theta is not 24 to 26, right? The theta is 42. How'd you guys get 24? How'd you guys get theta of 24? Theta is 42, right? So you say, why is that important? So if this is quiet for one day, right? You know, usually we try to make on these weekly iron butterflies about 10%. If I'm making $42 on theta, right, you're making about 8% of your margin in one day. So some of you guys are saying that you're showing the theta is only 23. I can go look at that in a second, unless I wrote the number wrong. Let me look at this real quick. Have I ever made a mistake in my life? Oh, you betcha. All right. So let's look at, I put it in here. Let's see. So here's our trade. We did the 21. Let me look at the Greeks here. 2165. You guys are right. I wrote it down wrong. 24 theta. 2425 theta. So, but either way, when you get, you know, this is the first day, so we had 24. But once you're in the trade a couple of days, your theta grows pretty quick. So still the same point. Volatility is not as big a component for these short-term trades. Now, the graph on this, you know, here's your basic graph. This is your expiration graph. This is the short strike, 2165. That's going to be the head of the TP. And then this will be your maximum loss or your margin. So in this case, we set around $400 or $500. And okay, so again, how do we make money on a butterfly. Again, we're selling the options that have the most time premium, so your short options are at the 21.65. Your long option on the call side is 21.85. And on the put side, it's 21.45. So as you're selling your short options with a lot more time premium than your longs. So as we stay closer to 21.65, the spread and the potential P&L is going to skyrocket. Why? Because your shorts are going to decay quicker than your longs are. Does everybody see that? So this is the type of trade. This is a weekly trade. And let me just show you as we talk about live order example. Where's SPX right now? Where's SPX right now? 21.63. Okay, so at about 11 a.m. Central today, Thursday, July 14th, SPX was probably right around where it is now, 21.64.22. The mid price at the time was 14.45 to 14.60. For a second, it hit 14.70. And so again, when I'm looking at how I execute trade 7-8 days from expiration is different than how I would execute trades 35-40 days from expiration. And I'll explain why. So when I went in to do this trade that we talked about, I first I kind of looked at it for a couple minutes to see kind of what was the mid, because the mid will change. And it was around 14.45 to 14.60. It touched 14.70 for a second. So I want to get an idea on the range. Now, so I first put it in at 14.55. I can always cancel my order, doesn't cost me any money, and go lower, but I'd rather start a little higher. So I did 14.55. I moved it down to 14.50 credit at 11.01. I didn't get executed. I think the mid price is 14.30. Generally, when I'm doing a weekly trade that expires in 8 days, I don't mess around too much. I try to get an idea of where the mid is, go near the mid, right? See where the mid range is, go in the mid, and I may cave in 5 to 10 cents in RUT or SPX within a minute or two. Then I may hold my ground, but I try to get it on because theta is a big deal when you're doing a 7-day trade. Theta is not a big deal when you're doing a 38-day trade. So I'm a little more aggressive getting on a butterfly on a weekly trade than I am a 38-day trade. I still don't have it on, but if you notice the mids right now with the price about the same, 21.64, the mids are like 14.30, I think, somewhere around there. Why are the mids going down with the price about the same? Because the theta really kicks in on these things. So on short-term trades, I try to get them on, right? And because the theta on these butterflies, even the first day might be 30, right? So I don't mind caving in 10 cents or 15 right off the bat. Anyways, and again, I'm just showing a one contract example. Question says, Dan, can you be clear on trying to make 10% a week? Is that based on the margin? Yeah. So if you say, when I talk about a plan to make 10% on a trade, right? It's on your capital that you spent, right? If you put a trade on it at your brokerage firm, well, what does it cost you, right? So the margin or the risk of the butterfly on this trade was around $500 per one contract. So 10% would be $50. If I did it 10 times, that'd be a $5,000 trade. 10% would be $500. Does everybody understand that? So the yield is based off the margin or risk of the trade. Yes? Now, what does this typically look like? When I do a butterfly, for this example, and we put it on Thursday, am I looking to hold it till expiration? No. Typically, if I put it on Thursday and we did one of these every week for 50 weeks, which we would, right? Typical, if we put it on Thursday, I would say, if I put them on Thursday, I would say 60% of the time you're going to get out by Monday, 90% of the time out by Tuesday. You with me? Let me say that in Spanish and a little Hawaiian. If I put these on Thursday morning at 10 Central, I would say, let me say this again. If I put them on Thursday at 10 Central in the morning, I would say, let me say this again. I would say 20% of the time I get them off the next day on Friday, then maybe 60% on Monday and 20% more on Tuesday. Just give an example of how this world, how this life exists, right? And again, you know, you're talking 1 to 2 day trades, right? You with me? Any questions on that? Obviously, we're going to spend a couple sessions, and I'm going to give you guidelines and how to do this, and we'll put some trades on and everything. But anyways, that's an example of a weekly trade. So at least I wanted you, what are some things I wanted you to at least get out of this? Just talking about weekly butterfly today, a little bit on the execution, a little bit on the Greeks of it, and what did that look like? Now, how did we're going to do the 38-day trade next. Any adjustments? Yeah, there's definitely adjustments. We're not going to be able to get into that today. You know, on these weekly butterflies, which we'll talk about during the class, I'll give you a plan for some people that don't want to mess with all the adjustments. I'll give you a plan for no adjustments, and then I'll give you a plan with adjustments. Now, anybody ask, why did I do 20 wide here? Why did I do, anybody have any idea why I did 20 wide? What do you mean? I sold the at-the-money call and put at the 21.65 strike, and I bought the calls 20 points out of the money and the puts 20 points out of the money. I was 20 wide. Generally, I'm trying to get and we'll explain it more, but generally I'm trying to get my long options around a 25 or 30 delta. So you're going to be narrower with an 8-day trade and wider with a 40-day trade. And we'll get into that a little more, but I just wanted, at least by passing, mention when we're looking at this 38-day trade, it's not going to be 20 wide, right? A 30 delta would probably be 40 wide. All right, well, let's move on. As far as target gain per trade and how do you know when to take it off, yeah, that's all part of the risk management, which we'll be talking about with each of these trades during the class. It's tough to go over in a couple minutes here, the complete risk management and all that. Now, Steve said, doesn't 20 wide make it a low prob trade? If you did this butterfly if you do something at the money, whether you do it 20 wide, 30 wide, 40 wide, 50 wide, 60 wide, let me tell you a secret. Don't tell anybody. It's still a low prob trade, right? How do you get a high prob trade? Selling something more out of the money, right? So some people have this idea, hey, you know what I'll do? I can get a higher probability by widening out the butterfly, right? You ever hear that thinking? That I can get a higher probability instead of 40%, maybe I can get 55%. I'm going to widen the butterfly. Anybody ever hear that? But what's the problem with that? If you widen the butterfly, right, there's pluses and minuses of everything in life. If you widen the butterfly, higher risk, you're paying a lot more money. I don't care what you do. It's like, you know, it's like you can take a pig in mud and put a tuxedo on a pig and take him out for dinner, but he's still a pig, right? And if you're doing at-the-money calendars or at-the-money butterflies, the way you make money is not because of the probabilities, right? It's because of the time decay, right? All right. I'm running out of time, but I want to get through. So SPX, again, all I want to do, now here's a different type of butterfly. We did an iron butterfly. Now we're going to do an all-call butterfly, right? So just so you're all set, there's no difference if you're using the same strikes between an iron butterfly, an all-call butterfly, an all-put butterfly, an all-call butterfly, an iron butterfly. It doesn't matter. It's the same stinking thing, right? Say, Dan, which is better? None of them. All right, so here's an example of an all-call butterfly. I'm selling the same strike, but now I'm dealing with AUG 19 expiration, which is 35 days out. So what's the difference between this trade and the one I did before? This one's 35 days out. The other one was 8 days out. With me? All right, so I'm selling 2 of the August 19 expiration, 35 days out, the 2165 calls, and I'm selling 2. I'm buying my wings 40 points down and 40 points up, and now I'm paying a debit. For those of you who are bankers, now you get really confused and you think somehow it's better to do a credit than a debit. No, right? Yeah, and again, I'm taking for what I talked about today, I'm taking more of a neutral outlook on the stock. Not that I think the stocks aren't going to move, but I always start, especially weekly trades at the money, generally because that's where you're getting the most theta, and these are short-term trades. So the total debit is 10. A position Greeks on a 35-day trade or delta short 3. Here's your gamma. Your theta is less than half what it was for an 8-day trade. Your vega is bigger, right? So your theta to vega ratio, 11 to 88, 8 to 1, volatility is going to be a much bigger component on a 35-day trade and an 8-day trade. On an 8-day trade, I think the theta to vega ratio might be 3 to 1 or something like that. Your margin or risk is $1,000. Your margin or risk on an all-call or all-put butterfly trade is your debit, right? So if I do it 1 by 2 by 1 and I pay $10, that's $1,000 bucks. Does everybody see this? This is an all-call butterfly. But whether you did these same strikes in the puts, same thing. Whether you did an iron butterfly using 2125 calls, 2165 calls, 2125. I'm sorry. Whether you did an iron butterfly, if we sold the 2165 calls and bought the 2125 calls, bought the 2125 puts, and sold the 2165 calls, bought the 2205 calls. What I'm telling you is there's no difference. Iron butterfly, all call or put if it's the same strikes. All right, any questions on this? And then if you see, again, it's going to be a little wider graph because it's a wider fly. It's a 40 wide fly versus a 20 wide fly. And the main thing we're going to try to, and the main emphasis in this 4-week class is try to go over how do you make money in these things and what plan and what have we found that works on live trades over the last 10, 15 years. And that's what we're going to focus on. That's all that matters, right? You know, you're not going to get an award for being the smartest butterfly trader, right? Or you can pass a butterfly test. You want to learn how to trade these things. And that's what we're trying to make this as practical as possible. Now, on this trade, let's talk about, last thing, order execution for 35-day trades, much different. I'm much more patient when I'm doing if I'm doing a 30 or 35-day or a 40-day butterfly, I may even actually go underneath the mid because you're paying on this all-call butterfly, you pay the most for a butterfly at the money. You pay less as it moves away. And in a market like we've had lately that's moving around, you know, if the mid price is $10, I might put in a bid at $9.70 or $9.60 and leave it for a day. Because if we move 10 points away either way, which in this type of market, most people would bet that we're not going to just stay at one price for 24 hours. We'll move a little bit, right? even though the last 2 days haven't been too rangy, I let it come to Papa a little bit more on longer duration trades. So I'll get the questions in a second. Yes, you can do these trades in an IRA. So at 11:23 Central today, I bought one of these butterflies at 970 debit. SPX was at 2163.67. The mid was floating around from 940 to 1020. So, what I recommend when you're doing a 35-day duration trade, before you actually put your order in, watch it for about 15 minutes and get a good feel of where's the range of the mid, and then go in. That way you won't overpay as much. I was working another order to pay 955 debit when the mid was at 970, 975, but I didn't get executed. So again, that's another thing we're going to focus on during the class is how do you get good execution? I was on the other side of your orders for 24 years, 23 years as I was a specialist in the pits in Chicago. And so I have a really good understanding of, how the whole system works and can help you some in terms of how should you put your orders in and how do you get out of it and that type of stuff. And this is a 40 wide butterfly. All right. Well, you know what I'll do? There's just some information on us. But again, I'll answer as many questions as you have here in a second. But I just want to say, if you're interested in the class, we'd love to have you. It starts 2 weeks from yesterday. I think it'll be a very practical and challenging class for you to try to help you get more consistent in to me, one of the better income trades out there for weekly or monthly income, the butterfly. And so we'd love to have you. Let's see, any questions? Yeah, you can sign up on the home page. If you just go to home page of Sheridan Mentoring and you can get taken care of there. If you have any questions, you can call us or you can email me, Dan at Sheridan Mentoring, if you have any questions on the class. Mike says, can you explain how you choose 20 wide versus 30 wide again? Yeah, Mike, I'm looking at the long options. So the way I choose my long options, I'm looking for about a 25 or 30 delta. And so in an 8-day trade, a 25 or 30 delta will get you about 20 wide in the SPX or RUT. In a 35-day trade, a 25 or 30 delta would make your width a little wider, like a 40 wide. Bob says, I've been in a few of your classes and they are all great. Thanks for all your hard. Appreciate it, Bob. How long will I have access to your forums? Again, this isn't forums. You mean the student site? You'd have access as long as we're around. You'd have access to our class page. So you have all access to all of our sessions and the recordings. And the neat thing is, even if you go through it a third time and you had some questions on the material, right, on the material that we teach, you send me, there's a little thing there. You just click a button and ask a question. It goes to Dan, and I can see what class you took and ask the questions. Yeah, I'm not going to be able to get into adjustments and a lot of that today, but every class we'll be talking about adjustments and what we would do. Those take quite a bit of time. And as far as profit targets, sometimes it depends on a weekly versus a monthly trade. Every trade that we go, generally we'll go for 10%, but it depends. But we will, for every trade, every methodology, and we're just trying to go over with you probably the top butterfly methodologies that we've seen or that we've been teaching and that are the most effective and people are having the most success with in live trades, and that's what we're going to go over. As far as an iron condor versus an iron butterfly, iron condors are going to give you higher probabilities, and iron butterflies are going to give you much more theta at the beginning. So they're different types of trades. Which trade do you think if the option volatility decreased, you'd make more? What do you think? Iron butterfly or iron condor? Well, you'd make money on both, but you'd probably make more on an iron butterfly. Why? Because they're wider. They're wider, and you're selling the ones with the most time premium. And people in our community who have done weekly butterflies or 30, 40 day out, you know, if they're staying with the program, good risk management, there's a pretty high success rate on these things. Do we do these butterflies in low volatility? Yeah, we do these butterflies in low vol, high vol, when the price is at all-time highs, all-time lows, whatever. And that's, again, another thing you'll learn during the class is how we might tweak these butterflies when we're at all-time highs and the VIX is 12 versus we're at 1900 and the VIX is 25. Aren't iron condors and iron butterflies the same thing? Well, they're the same thing in terms, so no, the answer is no. But are iron condors and iron butterflies, could you say they're both, you're doing a call credit spread and a put credit spread? Yes, you are, but you're doing different call credit spreads and put credit spreads. All right. If you have any more questions, I think we'll cut it off here, but you can email me, Dan@SheridanMentoring.com. And again, we'll launch the 4-week class starting 2 weeks from yesterday. We'll be glad to have you. Have a great day, everybody, and we'll see you next time. Thanks.